Okay, let's dive right into it. We're digging into the latest quarterly report from a company really making some noise in the edge AI space.
That's right. We're looking at their Q1 for fiscal 26. The goal here is really to unpack this earnings call information, get past the headline.
Exactly. We want to understand the key numbers, sure, but also what's behind those numbers, their strategy, especially around edge AI and what it all means for this whole tech trend.
Consider this your shortcut. We pull out the valuable stuff, connect the dots so you get the picture without wading through everything yourself.
All right. So starting with that snapshot, Q1 numbers, they looked pretty strong on the surface. Revenue hit $85.9 million. What's your take on that figure?
Well, like you said, $85.9 million. That landed nicely in the upper half of their own guidance. But more importantly, it's the growth, right? 57.6% growth compared to the same quarter last year. That's significant. And it was up 2.2% from the previous quarter, too. That year-over-year jump really catches the eye.
Yeah, nearly 60% year-over-year is definitely impressive. How did that translate down the line, profitability, cash?
Good question. So non-GAAP net profit came in at $3 million. That works out to 7 cents per share for the quarter.
Okay. And that non-GAAP, just quickly, is adjusted for certain items to show operational performance, yeah.
Exactly. It gives a clearer picture. And their balance sheet looks very solid. They finished Q1 with $259.4 million in cash and marketable securities.
Wow.
Yeah, that's up sequentially about $9.1 million and up a lot year over year, $56 million more than last year.
And they kept that free cash flow streak alive, didn't they?
They certainly did. Another $10.2 million positive free cash flow in Q1. That makes it, believe it or not, 16 consecutive years.
16 years in tech. That's quite a run. Shows a pretty resilient business model.
It really does. Generating cash consistently for that long says something.
Okay, looking at the different segments they sell into IoT, automotive, any shifts there in Q1?
Yeah, a little bit. Sequentially, so quarter over quarter, their IoT applications saw mid-single digit growth. Automotive revenue was actually down slightly, low single digits sequentially.
Oh, interesting, down.
Well, sequentially, yes. But, and this is important, compared to a year ago, automotive was still up over 20%. So that longer-term trend in auto still looks quite strong, even with that little dip from Q4.
Right, okay. Context is key there, so that covers Q1. But what about looking forward? Did they give an update on the full fiscal year?
Ah, yes. And this is where it gets, I think, really interesting. Because based on that strong start, they actually raised their forecast for the full fiscal year 2026.
Raised it, okay.
Yep. They moved their revenue growth estimate up from the mid to high teens range they gave before to a new range of 19% to 25% growth for the year.
19 to 25%, that's a decent jump. What's the midpoint there, roughly?
The midpoint of that new range works out to about $348 million in revenue for the year.
So definitely signaling more confidence, though I think they mentioned the guidance range itself is a bit wider than usual.
They did, yeah. They were upfront about that. They tied the wider range to, ongoing geopolitical uncertainty. It's kind of a hedge against potential macro issues.
Makes sense.
But the main point is, even with that uncertainty, they felt good enough to lift the overall growth target.
Got it. And what about the immediate next quarter, Q2?
For Q2, the current quarter, they're getting revenue between $86 million and $94 million. They expect that mid-single-digit sequential growth in IoT to continue, and they see auto revenue ticking up slightly from Q1.
Okay, so strong numbers, healthy cash position, raised outlook for the year. What's really fueling all this? What's the engine here?
Oh, it's very clearly Edge AI, no question. They highlighted that Edge AI revenue made up over 75% of their total revenue in Q1.
Over 3/4 of the business. Wow. And wasn't this the fourth quarter in a row for record AI revenue?
That's exactly right. Fourth consecutive record. It just, hammers home where the real momentum is. And this strength isn't just one product either. It's coming from across the board, their newer 5-nanometer chips, the CV5 and CV7 families, but also their established 10-nanometer CV2 products.
So broad-based strength within AI.
Yeah, and critically, they also pointed out that their average selling prices, ASPs, kept going up. They're capturing more value per chip.
Right. And what's fascinating, I think, is how they started strong in one area, security cameras, and seem to be really branching out now.
That's a really crucial point, actually. They were pioneers, you could say, in Edge AI for enterprise security cameras. But now they're taking all that experience, that know-how, and successfully applying it to a much wider range of applications.
To the point where security is now less than half their business.
Precisely. Less than half. which really shows how much they've diversified beyond that initial market.
And they gave quite a few specific customer examples on the call to kind of illustrate this, right?
They did, yeah. It helps make it tangible. So in enterprise security, you've got new high-res AI cameras using their CV72 chip, even a wearable device using a smaller chip, the A6LM.
Wearable AI.
Yeah. Then moving into broader IoT, they mentioned the new Insta360 8K camera using their CV5. Garmin's using their H32 chip in a cyclist camera for safety features.
Right, I saw that one.
And industrial uses too, like Hughes high-speed readers using their CV75 with third-gen AI, and a Hardly Lenovo video conferencing bar using the CV72 for much better AI performance.
Okay, so IoT is definitely diverse. What about automotive examples? Still a big growth area.
Absolutely.
Yeah.
They flagged wins in multiple regions. Japanese car makers using the CV25 for things like data logging, multi-camera setups. ZEEKR, the EV brand, is using their CV28 in the 07 GT for like access control and monitoring. And then in the aftermarket, ThinkWare is using the CV25 for ADS and driver monitoring, while Royal Easy is using it in fleet telematics to actually identify risks using AI right there in the truck.
It really drives home that point, doesn't it? AI isn't just a data center thing anymore. It's moving right into the devices we use.
Exactly. It's migrating to the edge. And this company is clearly positioning itself as a leader in that migration. They mentioned shipping cumulatively over 32 million edge AI chips so far.
32 million. That's a serious footprint. So building on that success, where do they see the next phase of growth? How are they thinking about expanding their market?
Well, they talked about their serviceable available market, the SAM. For their current focus areas in automotive and IoT edge AI, they see the growing pretty strongly, high teens compound annual growth rate over 5 years, reaching almost $13 billion by their fiscal year 2031.
13 billion, that's a sizable target market. Where does the expansion come into play? Any new areas they're targeting?
Yes, a big one they called out is what they term edge infrastructure.
Edge infrastructure. Okay, what does that mean exactly?
Think of it as layers in the network that sit between the actual endpoint device, the camera, the sensor, and the main cloud. It's a place where data from potentially multiple endpoints gets gathered and processed locally.
Ah, okay, like a local aggregation point.
Right. And the idea is this enables more powerful, more complex AI features. Things like those big multimodal vision language models that might be too much for a single chip on the camera itself to handle.
So processing closer to the source, but maybe consolidating data from several sources.
Precisely. And their strategy here involves their existing N1 chip family, but also, and this is new, developing a whole new family of AI system on chips, AI SoCs, specifically for this infrastructure layer.
A new chip family.
Yeah, they mentioned it's leveraging their existing third-gen AI accelerator tech and software investments so they can develop it relatively quickly. Sounds like it's pretty direct response to demand they're seeing emerge in the market right now.
Okay, that brings up an interesting point that someone asked about. Why do you need AI both on the device and in this infrastructure layer? Doesn't that seem redundant?
It's a fair question, but there are some very practical reasons for it. First off, think about the sheer number of cameras and sensors already out there in the world. The installed base is massive.
Billions, probably.
Right. You can't just rip and replace all those overnight with the absolute latest AI chip. It's just not practical or affordable. So an edge infrastructure box can take feeds from these existing, maybe less capable cameras and add a layer of advanced AI processing centrally.
Ah, so it's an upgrade path without replacing every single endpoint.
Exactly. And second, AI models are evolving incredibly fast, especially the really big, complex ones like generative AI models. It's often much easier and quicker to deploy updates or new, more powerful models at that infrastructure level, where you typically have more processing headroom and flexibility.
Rather than pushing updates to millions of individual devices.
Right. So you might have the endpoint camera doing, say, basic object detection using an efficient model, like a CNN. Then the infrastructure chip takes that feed, maybe combines it with others, and applies a more sophisticated analysis, perhaps using a large vision language model for richer understanding or even generating descriptions. It's a layered approach.
Okay, that makes sense. Layered intelligence. Beyond infrastructure, did they mention any other emerging areas they're eyeing?
They did. Robotics. They framed it as being kind of where autonomous driving was maybe 5 years ago. It's early days, lots of companies prototyping, but huge potential down the road.
So another long-term bet.
Seems like it. Their existing chips, like the CV5 and CV7 for perception and the N family for control, are already finding use in robotics prototypes. But they see a future need for more integrated robotic domain controllers and specialized AI software stacks as the market gets bigger and more complex.
And are they changing how they approach that market? Sounds different from selling to huge car companies.
Yeah, they actually mentioned they plan to talk more next quarter about adjusting their go-to-market strategy for robotics. Because the customer base is much more fragmented, often smaller companies, smaller volumes initially, compared to their big automotive or security clients. So it requires a different sales and support approach.
Interesting. Okay, one more on that edge infrastructure space. Who are they actually competing against there? Is it other specialized chip companies?
They touched on that. They acknowledged that, yeah, you do see more general purpose processors in that space, things like FPGAs or even GPUs sometimes being used.
Right.
But they really stress that their angle, their competitive advantage, comes down to efficiency, performance per watt, better thermal characteristics, and lower overall system cost, because their chips are purpose-built for AI workloads, unlike those more general purpose options.
Efficiency as the differentiator. Got it. Okay, let's maybe dig into a couple of the finer points from the Q&A. Analysts seemed keen on the details of that raised full-year guidance.
They were. Someone asked if raising the guidance meant the second half of the year would look different sequentially than usual. Management pushed back on that idea.
They don't expect weakness later in the year.
No, they said they don't foresee weakness. In fact, they noted the high end of their new, wider guidance range actually implies a pretty normal seasonal pattern for the rest of the year.
So why the wider range then?
Just that geopolitical uncertainty again. It's providing a wider buffer for potential external factors, not because they expect the business itself to slow down unusually. They still expect the typical shape. Q3, the October quarter, to be up from Q2, and then Q4, the January quarter, to be seasonally down.
Okay, so normal seasonality expected, just with a wider band of uncertainty. What about gross margin? They guided Q2 non-GAAP margin slightly lower than Q1, even though ASPs are rising. How does that work?
Yeah, that's a good pickup. They explained that quarterly gross margin isn't just about the overall ASP trend. It's really driven by the specific mix of customers and products that happen to be ordered in that particular quarter.
Ah, the mix.
Right. Different customers get different pricing. Different products have different inherent margins. So the specific blend of who ordered what in Q1 resulted in one margin, and the projected blend for Q2 just happens to work out slightly lower overall. It fluctuates based on that mix each quarter.
Got it. Mix dependent and inventory. Any signals there, either their own or their customers? Supply chain health.
On customer inventory, they said they feel comfortable based on their conversations. Customers are, keeping an eye on things, but apparently not building up excess stock.
Okay.
As for their own inventory, it did go up, along with accounts payable. But they clarified that this wasn't about funding new chip development or anything like that. It was mostly about strategically building inventory to make sure they can meet the strong demand they see coming for the products. Supporting the raised guidance, essentially.
Proactive inventory build for demand. Makes sense. Lastly, there was a question about market share, specifically in security cameras.
Yeah, they addressed that, but specifically for the market outside of China. Their view is that they hold the majority share in the mid-range and high-end segments of that ex-China security market.
Mid and high end.
Right. They also made it clear they don't really play in the very low-end, high-volume part of the security camera market. That's dominated by other suppliers focused purely on lowest cost.
Okay, good clarification. So, wrapping this all up then, sounds like a really solid quarter, primarily powered by that booming edge AI business.
Definitely. Strong momentum there. Over 75% of revenue.
And they translated that into a raised full-year outlook, signaling confidence despite those macro uncertainties they mentioned.
Yeah, increasing the growth target sends a strong message.
Yeah.
And strategically, the focus seems clear. Keep pushing edge AI, expand the addressable market into areas like that edge infrastructure concept, and nurture these emerging opportunities like robotics.
Leveraging their specific architecture and software know-how as the key advantage.
Exactly. So we've tried to pull out the core insights here. The numbers, the drivers, the strategy, what they're seeing in the market. Hopefully gives you a clear picture.
Absolutely. Now, just a reminder, everything we've discussed is based on public information and our analysis. It is definitely not financial advice. But thinking about all this, edge AI, infrastructure layers, robotics, it does spark a thought, doesn't it? Just consider the speed at which these AI capabilities are shifting, moving from huge data centers down into everyday devices, cars, cameras, factory equipment, maybe robots in our homes or workplaces sooner than we think. What does that really mean for how we live, how we work, how we interact with technology when AI becomes truly embedded all around us, not just in the cloud, but locally too? This deep dive gives us a fascinating window into that acceleration.
It's a huge shift and definitely one to watch closely.
Indeed. We'll be back soon with another deep dive breaking down the latest information that matters to you.